thank you. In today's session, I'll explain how our trading system works. In other words, what I try to see in the trades. So I'll explain. And then if you're a member, how you can follow me, my trade messages to maximize the gain. So that's the purpose. So I try to teach because I know there are people who are not following properly or they don't understand how they are supposed to trade. There's a lot of training required, even though if you're following. So I don't know if you are properly following the proper risk management, entering proper number of contracts or shares. What are you doing? Are you getting out at the first target or the second target or third target? What are you doing? When I was learning in the beginning, I did not have any such method or nobody was telling me. But then over the time period, I evolved. So I constantly am thinking like 24 hours, except when I'm sleeping. So I will explain to you the messages and how you can manage your trade. So today today Google alone gave me a $25,000 profit and it's still moving. So there is a limit. If you're trading calls, then there is, and especially if you have expiry looming, like June calls. So we need to close. So even though Google is moving right now is 117.50, but it's getting very overbought. So and if you have calls and you have tremendous gain, then it's prudent to sell today because today is the day after the news. So the news came yesterday, it moved up, and today also moving up. So there's a second day of reaction. So we need to close the calls. And take some profit on the shares also. So Google is going for 119 right now. Maybe if it breaks 119, it'll go to 125. So Google is great. It broke out of its trading range. If you look at the chart, if you put the Google on a daily chart, you will see it broke the range. So whenever the stock breaks the range, tight range, it means doing something. Why is breaking the range? Because if the stock is trading in range, there is a balance in the between the buyer and the seller, demand and supply. So when it breaks the range, tight range with some volume, it means the new buyers. The sellers have taken out, and now the buyers are in. So a new catalyst. So that's what it is. Whenever we trade, we need to look for the catalyst, some catalyst which is making that stock move. Um, Without catalyst, unless you have some insider news, without any catalyst, you are a long-term, like a long-term trader or long-term investor. So for short-term trading, we need some catalyst. And then we see if when we are acting based on this catalyst or this sentiment change, is it I'm too late or for the short term? So for short-term trading, like swing trading, am I too late or I still have potential? So Google was telling us for last 2, 3, 4 days that it's about to move. As is, uh, people know, the smart money knows already. So it's just the retail traders following along. But even in the retail trading, because there's so many traders, millions of traders, and millions of shares being traded, even the retail. So the stock moves. And you can see the activity in the option. So when you combine the activity in the option side along with the chart, technical analysis, then you get a pretty good reading on the stock. So we went long on RBLX, it gapped up, GT gapped up big time. You see the GT. I mean, if you look at the GT chart, it's trading, it was trading at a tight range, very, very tight range forever. But last few days, it was telling that it's getting ready to move, and today it gapped up. PayPal, look at the PayPal daily chart. We closed the PayPal puts yesterday. It gapped down. So the moment it gapped down, today is Thursday. So on Tuesday, yeah, on Tuesday when it gapped down, we start to buy puts. And yesterday we closed it by the market. So we were up huge. Then another one, look at it, CRSP. We closed the trade. All therapeutic stocks. No, I'm not. Sorry, I don't have a chart. I'm not showing any chart right now. I'm just talking. So you can put the chart on your daily. So just I'm giving you example. I don't have chart right now. So you can put the chart on your daily. I mean, if you're a trader, you can put these symbols on your daily time frame and see what I'm talking about. Unless you're driving and you're on the cell phone, and so just make a note of these symbols. So I'm just giving you some examples. So CRSP therapeutic. So all these days, the therapeutic companies, they are moving. So another thing, when multiple stocks in one group move up or down, that is another confirmation that this industry group is moving down or this industry group is moving up. Like regional banking were moving down, so we bought puts, made money. Oils, oil, they move up and move down. I'm not interested in buying oil stocks or puts or calls, whatever, if just one is moving up and down for some reason. If the group is moving up or down, then there is a pretty good chance. And then out of that, those 5, 6, 7, 8 symbols, then you need to choose the one which is uh, looking good. So BYND, today we open a BYND puts. So it's breaking down. Let's see what happened. So when I was starting the trading, my trading career 15 years ago, I was working as a SAP consultant. I had a great job. I was an integration specialist working for SAP America. Then I quit SAP America and then went work with Deloitte, work with Accenture, KPMG, and other top-notch consulting firms, Fortune 500. Even then, so I had an integration. So this is another. I have a background of system thinking. So as a trader, if you want to be successful, you need to learn how to develop systems. Just reading the chart is not enough. You need to have some kind of a system. One input goes into another one, and then another result comes out, or 3 or 4 or 5, 6 components are working together and giving you the result. So being IT, having an IT background, and so I have IT background, SAP consultant, business process, and then MBA in finance. So all that helps me in my trading. So I started thinking in that terms when I was introduced to option trading uh, way back 15 years ago through a software called Wise Trade. So if you have heard of Wise Trade, they still have, but I don't think they are uh, alive right now. They're just barely breathing. So they had a concept called green line and red line, where when the green line is above, you buy, go long. When the red line is above, you go short. So that was a simple concept they had presented. So I bought their software for $3,000 and started trading option directly, trading option, no idea about the market, don't know anything about the stock chart reading. So I lost money in the beginning quickly. $2,000 is nothing. Open an account and got wiped out. So over the time, I met few successful people who guided me. So one of the traders don't follow this Bruce Lee advice. So Bruce Lee advice is valid anywhere. So his advice is to practice one thing 10,000 times, and it's there. So when you practice one kick 10,000 times, when you need to kick, you will use that kick instead of 10,000 kicks and practicing one. So that's what I did. I practiced few chart patterns, and if the trade is there, it's there. If it's not there, it's not there. And the trade is whether to the upside or to the downside. So simultaneously trading. Sometimes the tilt is towards the long side, and sometimes the tilt is to the downside. For me, my tilt is towards the upside. I believe the market is weak. Market is weak and choppy, but the direction is to the upside. So most of my trades are to the upside. Some trades, selected trades, are to the downside. When I say it, I um, go for it. So practice few kicks 10,000 times. Need 10,000 hours of practice minimum, maybe 20,000 hours. That's the minimum required. Traders don't have time to practice, don't have time to spend 10,000 hours. They want the quick result. 5 hour, 10 hour, they open the account and they just start trading and they start losing money because it's very deceiving. Trading is the hardest profession to make easy dollar, and trading is very deceiving. When I'm sure you have seen, when you buy calls, it goes down. When you buy put, it goes up. So something is wrong there. Something is wrong. So need to figure it out. And the thing is wrong is about the big boys. They know where to get in. They know. So dinosaurs. So that's what I was introduced about the dinosaurs. So we need to read the dinosaurs. So Baba, for example, Baba was dormant for a while. So I was looking at Baba, Baidu, and they're not doing anything. Suddenly they start doing things. So if I look at Baba, is facing resistance around 87, between 87 and 88. But I initiated the trade today long with the gap. So the Baba is trading with the gap up. So Baba initiated long, and software U is also moving. So initiated. BYND looks like breaking down. So I initiated puts. So that kind of thing. So dinosaurs can run but cannot hide the footprint. Another thing I was taught in the very beginning, so I was very confused. In option trading, the stop is once you have a conviction, you need to give need to give some room for your trade to work. So that's why I don't put any stop right away. I want the stock to tell me that I'm wrong, rather than me putting in option trading. You is different for the stock than when you're trading a stock. Because the conviction, you need to you need that symbol, one letter symbol or two letter symbols. Just a second. When we entering in the trade, we are reading the charts of the stock. There must be some conviction. That's why you enter. So if the stock goes a little bit $2, $3 other side, and the option goes for 5 points, 50% other way, and then the stock goes to your predicted direction, then you just get whipsaw. So start little and then build the position. So for instance, start little, Baba calls, start little, U calls, start little, and BYND put, start little, and in 1 or 2 days, next day, tomorrow or Friday or Monday, it will tell you, Baba will tell you that it's going up. I am going up. You will tell you that I'm going up. What happened, traders, they just don't have the skill to build the position, the winning position. They are greedy. They put all their money in one go, and then they sit on the side because they don't have. They just overexpose. So build your position. So $25,000 profit in Google just didn't come in one shot. And I say, okay, I bought these many shares or these many contracts. Now I hope it goes up. No, I initiate little, and then it tells me. Because when we are entering in the trade, we are making some decision. So when we are making some decision, we could be wrong. We are reading the chart. So when we are reading the chart, that's where we could be wrong, and that's the moment our risk is the greatest. So when we are opening the trade, that's where the risk is the greatest, because we are making the decision of putting our money on the line. So at that moment, you put little and let the stock tell you. And then you know, okay, yes, I got it right. And I am going to add more to my position. So yesterday, added more to the Google, and today closed. So yesterday was the first move to the upside after entering in the trade. So in the beginning, I was so I'm the kind of I'm sure you are also. I'm kind of that I go deep dive into anything. Like I need to know exactly whether I need to put apostrophe s or a period here or period here or the comma here or semicolon. What goes here? So that kind of thing. So have a big picture and then go into detail. But then detail, you cannot master every chart. So focus on apply the Bruce Lee techniques, what Bruce Lee is telling us, into understanding the key chart patterns. So that's what I did and I'm doing. So, and what I mean by key chart patterns is because not all stocks, not all patterns are profitable. They take time. Maybe they are profitable, but they take time. Maybe they are not reliable. They sometimes you win, sometimes you lose. So the probability of winning is not that great. Sometimes they don't appear often. And they appear once in a blue moon. So if you miss that trade, if you're waiting for that trade, then you miss it. So, and what if you are waiting for that chart and it appears and you went all in, and that's the trade which is a loser, come out to be the loser. So you don't want that kind of a pattern. You want something reliable, something frequent appearing, somewhere the risks and rewards, some kind of a momentum building, some kind of a new interest, some sentiment change, some catalyst is there, big boys are involved, some option activity going on. So something is going on. Sorry, I need to shut down my phone. So, so that's what it is. So I followed Bruce Lee advice and applied it to key chart pattern. So what happens in the morning when I wake up, I do my pre-market work, and then I'm very relaxed and calm. If the stocks, some stocks which are the kind of pattern I'm looking for, the behavior, the move, I take the trade after evaluating it. If not, then I don't. So it's very calm and peaceful and relaxed, and the relaxation and the relaxation come and the stress goes away when you are trading in a proper exposure. So your exposure is divided into various position, not just few position you open and then think of making a killing in that single trade. So don't do that. If you do, so for instance, if you build the position, then you have to know that this is the position which is the profit, and I'm overexposed. So I need to um, unload some of the contract or some of the shares in that position, because this is the position which is giving me too much profit and the balance is tilted towards that this single trade like Google. And if I don't take the profit, or if I don't offload some of my scale out, then it will be, my portfolio will be negatively affected. So there is an art to scaling in and then scaling out. So scale in, maybe average up or maybe average down. So I do average down and I do average up, because when the stock is moving up and there's a new catalyst or it created a new support after the pullback, that's the time we need to add more. So master few patterns, don't need to master all kinds of techniques. um, there are so many indicators, so many people just on a YouTube. So I don't know, YouTube found out about me that I'm a trader, although I'm watching some news, and the ad is coming, although I don't look for anything on YouTube, but the ads are coming. All the guys are just selling their indicators and whatnot. Somebody selling consistently make $500 a week. The average gain is 3.72. So think about it. Average gain, that guy is saying 3.72% gain, average gain. That means you really need to uh, be the aligned with him. When he enters, you enter. When you get out, you get. When he get out, you get out. There's no leeway to make 3.72% gains. Imagine that, 3.72% gain. You need to really align it. So not that kind of trading. So and then preparation. So I do the preparation constantly. I'm very rigid about preparing myself for the market, constantly evaluating the baskets of my stock. So I want to know which stock is moving up, which one is moving down, and I constantly evaluate those trades and put them in different baskets, like hardcore stocks. So Baba, Apple, Baidu, Meta, these are the hardcore stock which I evaluate every day. So Baba is a hardcore, so I put it there. I need to watch Baba, Google, because when they move, they move. When they decide to move, they start to move. So I need to watch. Then there are other stocks in the core stocks related to the market. Sometimes I trade those, but and I need to watch because they are related to the market. If I don't monitor these stocks, then I don't know about the market. Then there are non-core stock like GT. So GT was in the non-core baskets, meaning I just look at it once in a while, not follow. But when GT start moves, I need to watch. Carvana, so a stock like Carvana, I don't trade often, so they're non-core stock. Yeah, the small, then there are small cap stocks. So a small cap stock, there's something fundamentally there. So some fundamental news has come and have a catalyst, and they are moving, and there's a lot of activity in the option. So I also pay attention to the activity in the option side. So like Mara, NU, Riot, and all these small price. So small price stocks. Indices ETFs I follow because it's important to follow ETFs like DIA, SPY, QQQ, IWM. So when I look at the SPY ETF, so SPY is trading in a very tight range. So the market is moving in a very tight range. QQQ is looking the best among the ETFs. So QQQ is looking the best. PLTR, yeah, I look at PLTR. So PLTR is right now is pulling back. It so I don't have PLTR. I don't know, I missed it. It gapped up. I think it came gapped up because of earning 2 days ago. So not there. PLTR right now is pulling back, hit the resistance at 1050 something. Maybe it will go to 12 later, but right now, so I don't have PLTR. So indices ETF, I watched DIA, QQQ, SPY, IWM to figure it out which side of which if you don't know the ETF and indices or the futures market, if you're not evaluating, then you are trading in the dark. So I need to do that. Semiconductors ETF, I watch. Gold and silver, I have few position in the gold and silver, junior minor and some stocks, they were moving. So AEM, NEM, gold, and GD, XJ, GDX, GLD, SLV, all this. So I have few position in gold. And so another thing which we need to have is a trading system. So whatever way you evaluate your trades, chart patterns or some black box. So the trading system should be, so you need to have at least two trading system or two ways of trading, one on the long side and one on the downside. So one on the uptrending, one on the downtrending. But if you don't have, let's say you only have, people cannot trade on the short side, so they have difficulty in finding the trade on the short side. Somehow people don't are not good in trading the downside, but the downside is the fastest way to make money when you find the candidate, because the stock which is moving down is moving down on a panic or fear or something. The stocks which are moving up, they are moving up, there's a catalyst there and the buyers are coming in, and the buyers come in at a different stage. So they move the stock on to the upside. They move gradually, they move, but not as fast as the stock which are moving down. And for that upside, you get a lot of opportunities to add to your upside position. Whereas on the downside, the fall is pretty fast. And if there's a panic or there's some negative news, the stock is just falling. So there is only one door for exits. So exit has only one door. Entry has multiple doors. And the reason for multiple doors is because the various buy orders are triggering. So imagine the guy sitting in Fiji Island. He um, his his, uh, his idea of trading is when the stock goes make a new low after 52-week new low, I'm gonna buy. So he goes and buy the 52-week low. Then another guy somewhere on the sitting in China, and he says, no, the stock needs to make a new high after 5 days. 5 days of new high, then I'm going to go long. So he comes in and buy. Then another one comes in a 20-day moving average crossover. Then he buys. So there is a breakout coming, monthly breakout, weekly breakout, whatever it is. So there are multiple entries, the system triggering their buy. That's why you get the opportunity to scale in. Some news come in and they buy it. But for the downside, there is only one exit. The negative news is there. So everybody is getting out. So if you catch the moment everybody is getting out, that's where the money is in puts trade. So if you catch it, the move lasts maybe 2 or 3 days. Boom, 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 and then that's it. And then it subside. Somebody thinks this is a good buy, so they come and buy, and then your put start to give back the profit, and eventually you give back. So I give you example HAL puts. So I sold half of my position. It capped down, and that was my trigger to sell. 28 is the support. Maybe by end of market, close the market, I'll sell the rest of the HAL puts. So HAL, I've been holding for a while now. Finally, another trade, puts trade which I'm holding is FOUR4 puts, and it's just don't refuses to fall below 58. So I may sell that because the puts, they need to fall right away in 2 3 days. Or for the puts trade, if you can read the chart this correctly, that this stock has topped out. So you initiate your position in the put trade because that's your theory that the stock has topped out and is ready to fall. One example I give you is Las Vegas Sand. So Las Vegas Sand, in my opinion, has topped out and is just ready to fall. It's trading right now at 61.40, something like that. So if you put the LVS on a daily chart, you will see how it's trading at the congestion. It's created a congestion zone, so it looks like it's gonna fall. So I initiated the trade in LVS puts, and the day to start to crumble, like you can see it, everybody can see. That's where we build the position. Otherwise, if it breaks the tight range on the upside, then close at the loss. So if the loss occurs, the loss will be smaller because the position is small. And when the LVS starts to break down, that's where build the position and hold for 2 3 days, and that's it to get out. So if you have only one trading system, which is long side, then you need to have a basket of those ETF which move to the upside when the overall market is going down. So when the market is going down, your inverse ETF is moving up, and you have the ability to read properly the direction to the upside. So that's why you need to have a basket of ETF. So the first thing which we do in the morning when the market starts is the price discovery. So this is somewhere I read this term. I don't know. I just read it and it stuck in my brain. So I call it also price discovery. So price discovery is the stock is moving up and it moves. So the day chart is my main chart. So everything is happening on a day. So I'm not. I can look on the weekly. I can look on intraday. But if I start trading, if I'm starting my fresh day, then I'm looking at the day chart. So that's where the things I look at first. So day chart. So whether it's a black box or I'm doing, I don't have any black box. But if you have a black box, the black box meaning the logic is behind the creator of that indicator has done something. So he's just putting some green arrow, red arrow, or line, green line, red lines, and it's telling you, okay, this is a buy, this is a sell, and you have to trust that black box. The black box uh, system may work in one kind of a market, and if the market is not there, then all the trades are just losers, because the trades coming out of the black box was meant to be a certain kind of market. So in other words, we need to know the type of market also. If you don't know what kind of market we are trading, then you will lose money. Sometimes the market is such that you need to trade both sides, up or down. Sometimes only up. Don't trade on the downside, because the the majority of the 80%, 90% of the stocks are moving according to the market. And if the market is to the upside and you're opening a position on the downside, it's not going to work. But if the market is choppy, one day it goes up, one day it goes down, then you need to trade both sides. So black box, you need to find the black box which matches that kind of market, the black box which matches your personality. So the you if it's not matching your personality, your style of trading, the black box will not work. If it's not matching your the market environment, it will not work. And the risk and reward. So there's so many issues with the black box. Chart pattern, you can master it. So when you master the chart pattern, it's yours. So that's what I did. I don't do band trading. It's not for me. It's um, you know um, when the stock touches the lower line, you're expecting it to go up. And the touches the upper line, you're expecting the stock to go down. So I don't do band trading. It's not for me. I do the trend trading. So in the trend trading, there are various styles. The trend trading could be the stock is trending up. It's a very nice trending stock. You're looking for the pullback at some kind of a support, and when it reaches and you have a pretty good idea about the support, you initiate your long position, and you keep doing it, keep scaling in. When the stock goes up, pulls back to the support, you add some more and expect it to go up. So that's trend trading. And most of the traders, they are late in identifying the trend. They are getting in when the trend is about to end, not when it's beginning. They are wrong in trend trading also. Sometimes they get lucky because the momentum is there and they just made money. There is no thought process. There is no systematic way. There is no rule. So when the most of the trend trading, if you have a trend trading system or you learn the trend trading somewhere, uh, just think that you may be late, because for trend, um, three or more, for upward trend, some three or more higher high and higher lows needs to be formed. And for downtrend, um, three or more uh, lower lows and lower highs needs to be formed. And this is being recorded. I'll post in my YouTube channel, The Real Trade Genie. So most of the time, the trend trading is late. So you need to understand something called dynamic trading, trend trading. So dynamic trend trading. So while the trend is building, that's where you're getting in. So for trend trading, the change in the sentiment, detecting the change in the trend. So what method you have to detect the change in the trend? If you don't have a method to figure it out, the change in the trend, then you will miss out. So the most of the money is made when when you have a way of figuring it out, the change in the trend detection. So um, So give you example, the stock is trading in a range, in just tight range. So it's going up and down, and suddenly there's some move comes, some catalyst, some news, some activity, some volume build up, some option volume call, this, that. So that's where you know, okay, this is it. This is the change in the trend. The sentiment has changed. Sometimes the stock gets oversold, way oversold. So when the stock gets oversold, if you have deep pocket and you believe in the oversold, um, you can get in the buying the shares. The calls, if the stock is oversold and you buy the calls, the stock can remain oversold till your option gets expired, and then it will move. So then you will say, okay, I read the oversold condition correctly, but I bought the calls and I lost money because time ran out. So 2 days ago, I sent the PayPal puts trade, and somebody sent me email saying, "Hey, you're buying puts. I think PayPal is oversold, so I'm buying calls." So when the stock is going down, you're catching. I'm not the kind that when the stock is really going down, ticking down, the direction is to the downside. You don't have to short that stock. If you think it's oversold, you don't have to. You don't have to buy calls right away. But if you don't not buying puts, but you don't need to buy calls because the trend is to the downside. And if you think if you're reading the oversold correctly, sometimes you will read correctly, most of the time you will not. So you rather wait for some kind of a change in the trend, some detection. So you put that stock in your watch list. So that's what I do in watch list. If you think a stock is in the overbought zone, you don't have to just buy. Um, okay, it's an overbought zone, so it moved up big time. So I'm going to go short in it or buy puts. What if overbought stock remain overbought and it finds a new catalyst and then it breaks out again? So I don't do that kind of trading. One thing which helps a lot, if you can master the art of reading the support and resistance, and what kind of support, how strong it is, what kind of resistance, how strong it is. So I do rate my support and resistance. Uh, is it a strong resistance or is it strong support? How recent it is, how old it is, and how many times the support and resistance tested. So for instance, somebody mentioned PLTR. So PLTR made a double top right there. If you look at the chart, PLTR, so it's behaving like that around 10. It has a strong resistance at 10 and 40. That's why it's behaving like that. If I was in a PLTR trade before the earning, my exit would have been today or yesterday, on a gap up. So PLTR. So PLTR, knowing that it has a strong resistance at 10, I would have taken the profit. That would have been my red target if I had position in the PLTR. Well, I don't know. The strong resistance is there majority of the time, and the stock is facing the resistance, and I'm in gain. I will, especially if I have calls, I will lose money over the number of days, because I don't know how long the stock will take to break the resistance, and I start to give back the profit. So I ask question later, shoot first. If the major resistance is hit, I'm out. See you later. So why bother holding it, because I can always buy later again or on a pullback. Another kind of, so support and resistance is very important in each trade. I monitor the support and resistance. You have to look at the support and resistance from the weekly point of view also. So on the daily chart, the stock is looking great. On the daily chart, the stock is looking great. It's just falling apart. And then when you look at the lean towards the weekly chart, so you must lean towards the weekly chart. You're discovering the symbol on a daily time frame, but then you have to lean towards weekly and say that weekly, are you clear? There's no support or resistance, depending on the direction. And then if there's no support resistance on a weekly, the way in you're trading, if you're trading to the downside, then there shouldn't be any support on the weekly. It's just not there. And so it's not there. And if you're trading the calls alongside, then see how far is the resistance. If the resistance is very close, then you need to avoid that trade. But if the resistance is far, you're entering at 6, and then you see the resistance at 10. So there's a $4 difference in the price. So if you're entering at 6 and you're buying calls and you're exiting at 10, your plan is 10, then that's pretty good move. And it so happened, I just read yesterday, I finished the book called 0 to 1 by Peter Thiel. So PLTR is owned by Peter Thiel, the founder of PayPal. So it so happened yesterday I just finished his book, uh, 0 to 1, and he is talking about um, his company PLTR. Anyway, so breakout. So breakout is good. So breakout needs to happen for powerfully from the consolidation. So breakout also have many types. So breakout out of the congestion zone, or breakout out of the 52-week high, or breakout out of the some kind of a resistance zone. What kind of a breakout? So what is happening when the breakout is occurring? Is the volume there? Is the activity there or not? So breakout, I do trade breakout. Breakdown. So breakdown example is a PayPal. So PayPal was breaking down 2 days ago. So when I realized that, I bought the puts. So breakdown along with the gap down. So gap down is there's a difference between the yesterday's close price and today's open price. So there's some gap between the yesterday's close and today's close, and the volume is building up. Activity is there. There's a negative news. So the stock gapping down and breaking down simultaneously. So when that happens, you have a pretty good chance. Then you evaluate how far is the support. If you cannot find the support on a daily chart, then you look on the weekly chart, on a monthly chart, figure it out the support. If you find the difference between the current price and the support, you immediately do the calculation that this is the difference between the current price and the support price. And then at that time, then you have to, if you're trading option, then at that time you have to evaluate where is the activity, which strike and which one have the activity. That will also tell you some indication where the traders are um, thinking that stock will go. So for instance, if let's say PayPal, so PayPal gap from 75 to $70. So PayPal gap from 75 to $70. So if the PayPal gap from 75 to 70, so there's a $5 gap down. So if you had bought at puts at 75 and it's, suddenly it break down to 70, then I mean you're a champion. But let's say you did not read that 75 and it gapped down and you saw at 69. So you saw at 69 or 68. Now you have to see, okay, I know I missed it. Someone who has either someone has an inside news that PayPal will tank, or just took a flyer, or he has some indication of the PayPal gonna gap down, whatever it is. But most of the time we don't have that information. So you need to read the gap down. So gap down, when you spot the gap down, so you go and look at the daily. When you're looking at the daily chart, you see, okay, is there a support somewhere, previous turning points? And if you don't find it, then you look at the weekly support. And if you see the weekly support is far, then when you're evaluating the option chain, then you see where is the activity, where is the volume, which is strike. So strike will also tell you, maybe there is an activity at 65 strike, which is out of the money. Maybe there's a lot of activity at 62.50 strike or 60 strike. So this is where it gives you some idea that this is where the traders are expecting. When the stock moves down, so when the stock moves down, right now you're buying out of the money puts, but when the stock hits the target, your option will be at the money. That's where the most of the premium is. So Buying out of the money puts works great when the momentum is there. So out of the money puts and it goes in the money faster. Usually you buy one strike in the money for the puts. If it takes time, then you don't lose the time value. So if I see the volume, if I'm looking at the PayPal and I see the volume at 62.50, I would buy 62.50, and I'm expecting the PayPal to fall faster towards 62.50. Or I may buy 65 strike puts. So when it crosses the 65, right now it's out of the money, let's say, it's trading at 67, but I'm buying puts at 65. So when it goes to 65, the premium is just keeps moving up. And when it crosses towards the 62, goes towards 63, 62, then I'm 3 points in the money, and my profit will be the percentage wise will be higher. So gap down is tricky. I need to read correctly. Gap up reversal, I don't do gap up reversal. The gap up reversal you can do if you know the gap up is just temporary and the stock is about to fall. So gap up reversal I don't do. In the gap up, um, only most of the time on the gap up, not the gap up reversal. Gap up reversal works great when the market overall is bearish and the stock comes with the news and it gaps up, and you know it's gapped up, and then there is no follow through. So some chart patterns I look at, and then so it's the gap up reversal. It can be very profitable if you can read it correctly, that this gap up happened right at the resistance level, and there's no follow through. There's no buyers coming in to buy, and the stock will pull back. So the gap up reversal work in that, but most of the time I'm not doing it. Gap down reversal I take. So the stock can gap down for many reasons, and usually it gaps down to 50-day moving average or some 200-day moving average or some support, and then the somebody decide that this is a fair price, this is a very good price to go long, and then they buy. And then you can also see the activity. If you see the activity in the option on the call side, you can make pretty quick return on your money, and it moves fast. But you have to be what happened in the gap down. So when the stock gaps down, it reverses, and it reverses towards the some kind of a resistance is there. So when you're trading a gap down, you have to really do two things correctly. uh, Figure it out that this gap down reversal is genuine, is happening. Now the low has been formed, so that's my low. I know this shouldn't violate, and then the reversal is happening. So when the reversal is happening, where is the resistance? You have to really quickly figure it out, the resistance, because the gap down occurred and the stock is moving up. It's going towards, it's going to stop at some resistance. So unless there is a V-shaped reversal, which happens sometime when there's a V-shaped reversal. The stock just gaps down and then boom, 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 it just keeps going up and breaks all the resistance. So be pretty good at the identifying the resistance, and before the stock reaches the resistance, you need to exit. And when you're exiting, you know you have enough profit. That's great. Intraday reversal, intraday reversal when the stock goes down. Overall, the market, there's some negative news, the stock is going down, and when the negative news goes away, some positive news come, and then the stock starts to form um, like intraday reversals, hammer on intraday chart, or somewhere there is some negative news is now a positive news. So I like the intraday reversal. If intraday reversal is happening, I go long on intraday reversal. Moving averages breakout I don't do. So like 20-day moving average or 50-day moving average breakout or some kind of a crossover breakout, so I don't do, but I watch moving averages, but I'm not doing it. So this is a price discovery based on any method. So just there are various ways to skin the cat, or they say, what they say, pull out the trick rabbit from the hat. So depending on what's happening, you're applying that technique, so reading it correctly. So whatever is happening to the chart. Then you need to apply some filters. So to make your life easy, the filters make your life easy. So you look at you remind yourself. You say, okay, what is the volume? Oh, the volume is uh, too much. It trades. Baba is moving. Okay, the Baba moving up, and it gapped up, and it's already trading at 1 million shares. Only 15 minutes passed, and 1 million shares. Now 1.5 million shares. Now it's 2 million shares. I don't know what's the volume right now on Baba. So some kind of a volume is building up. So do some analysis. I also do the analysis on a relative volume. So you have to know only 30 minutes gone by and the volume is already there and it's gapping up. And there is a lot of calls. So when I look at the Baba options, I say, oh, 200,000 contracts already traded. On the put side is only, so the put side also has, so don't forget to look at the put side. Put side also have a volume, but it doesn't mean if the put side have a volume, it's all bearish. People may be putting on the bullish bet on the via puts. So you have to, if you just read the option data and don't master the market, don't master the stock chart reading, you're not going to succeed just by reading the option. You will fail. So read the chart correctly, read the market, and then take some help from the option. Traders just say, so many contracts being traded, I'm going long on this. And they may be buying at the top or maybe buying at the bottom. The puts, they're buying puts at the bottom. So don't do that. Option, just take help. Now another filter I apply is the price filter. So you can apply, say, okay, for option I will not buy you know more than less than $10, but $1.50 stock, if the stock is just $1.50 but the option is like 100, 200, 300,000 and there is a catalyst and you buy the option for 70 cents in the money, the 70 cents option can go to $2, $3, $4. So a lot of money is there, but there is no stop there. So if you put the stop on a $3 option or 70 cents option, the stock can do its thing and your option will be 50% down and then it will go up. So think about that. Average true range filter. So the stock moves on a on a normal, it moves, let's say $2 or $3. This is a normal based on the 14-day average. So if the stock moves $2, $3 based on the 14-day average or 30-day average, whatever is your average, and now it's trading beyond its average, so something is going on. So pay attention to that. Sudden spike in volume. So sudden spike in volume doesn't mean that I'm watching volume on a 5-minute chart and then I see the spike and then I go long. I don't do that. If it's good to know that there's a spike, but that's not the criteria for going long or short. When I see the volume on a 3-minute, the volume is there. There's somebody knows something. No, somebody don't know anything. You just pump and dump, and some retail traders, you just somebody somewhere in some Discord channel or somewhere, they, the guru has already bought that I'm buying this, and then send the alert, and then all the retail boys, they go in and spike, and the guru is getting out at the top, and they are buying it. So don't make your decision just based on the spike. Have to have a systematic way of analyzing the volume. So 1-minute volume, 5-minute volume doesn't make anything. Does not, in my opinion, does not make any difference. You have to have a volume analysis on a day chart. Sudden move in price. So you need to pay attention why suddenly the stock is moving. So for instance, I tell you, you need to have a method or come to that level that when you are watching the tape, just the stock moving up, like in my language, Urdu, we call the horse moves tuk tuk tuk. So it's like the stock is doing some kind of a rhythm up and down. If you watch horses how they move, so that's the way the stock is moving. And if you are driving, let's say you're driving and you open an app. So I give you example. I'm driving and I open an app. It's 12 o'clock Pacific time, 1 hour left. And I open my app and I say, okay, let me see my position. And I say, Google, it was 109, 109 and 110. And now it's trading at 110.50. So I pull over and I'm not watching the chart. I pull over or I ask my wife, hey, keep an eye on the Google and tell me every 4 minute, 5 minute, what's the price? And then she tells me 110, 40. I say, okay, then what's the Google price? Oh, it's trading at 110.55. Okay. So I already know the target. And then the Google just tells you moving, tuk, tuk, tuk. So pay attention. Maybe just open an app. Okay, buy 200 more shares. What price? Just what price it is, 110.55. So I'm not haggling over that it's trading at 110.55 so I can get in at 110.50. No, I just buy at 110.55 because I already know I'm already in and I know the target. So Google is doing its thing. After 1 hour, when I look at Google, it's trading at 112.60. So so sudden move in price, um, if there are 20 symbols, you cannot watch the charts of 20 symbols. So pay attention to just the price movement and feel the rhythm and do something about it. So you don't have to watch the chart. So if there is a sudden move in price, pay attention and see what is going on. It was trading at 109, now it's trading at 110, 150. Something is going on with the Google. So pay attention to the price. So do that. Then I have alerts. So I set my many alerts, very tight alerts because there are many alerts. So opening range breakout. So for instance, if the stock is trading on a made a high, suddenly it opens and it made a high of let's say 86.50. So in the first 30 minutes, Baba made a high of 86.50. So I set the alert at 86.60 and I say, okay, when 86.60 comes and the 45 minutes have gone by, I'm going to pay attention. And if the volume is this, on top of that, I'm going to pay attention. Because if the volume is this and the price has crossed the 30-minute opening range, I need to pay attention. Then I'm also watching the call volume. Call volume is building up. So something is going on with the BABA and I need to pay attention. So opening range, break out the window. So in the beginning, when the market opens, let's say you have 1,000 stocks in your basket, and then when the market opens, it's like the horse race has begun. All kinds of dogs and horses are just running away. But eventually, it's a marathon. So eventually, after 30 minutes, some stock will die down. They will not move. Some stock will just continue to move. So you have a 45-minute window. So if the stock is making a new high, that stock is appearing on your 45-minute window. Then if the stock is moving further up, that stock with the new volume, because the volume has to build up, should appear in your 1 hour window. So that is the concept of opening range breakout, that new high is being made intraday and the volume is also increasing. And sometimes you just need to decide during the first 15 minutes when the market open, you decide that this trade, I know it's a new trade, new catalyst, and I need to get in. So get in, initiate a position. New intraday high made, so I keep an eye that if the new high made, so for instance, BABA, so I look at the BABA. Later I will show my charts and everything. So BABA made 87, 82 high. So far. So if BABA goes, so I will set the alert at 88.10. Let's say if it's 87, 82 is the high, I'm not going to put the alert at 87, 83 because 87, 82 and 87, 83 is nothing, some meaningful high. So let's say 88.10. So if BABA goes to 88.10, I get the alert say, okay, it's now at 88.10. So I will raise the alert for 88, let's say 50 or something like that. Same way for the low. So I was watching HAL. So I was constantly monitoring the low because I have put position. So sold at 28.20. and now is not going below 28.20. So I know that I did not receive any alert after the low is made. So it is trading above the low today. Another one, percentage up. We need to pay attention to the how much. People don't pay attention to the percentage. So it's all relative. If you are paying attention to only 50 cents move or 60 cents move, so on a $1.50 stock, the 50-60% move is too much. Whereas on a trade stock like Baba, the 50 cents, 60 cents is nothing. So percentage, pay attention to the percentage up and down, percentage up and down. Volume, I uh, from the very beginning, I need to see at least 30%, 40%. So this volume is going up, and then the above average volume. So if Baba trades 2 million shares and it's already trading 5 million, so it's 250% above volume. So some kind of a rating on the volume. So do you have a system on rating the volume on the basis of absolute volume? So do that, figure it out. What is the volume? Volume means there is some activity. If there's no volume, then why you are trading that stock? Unless you are a long-term investor and you think I'm a fundamentalist, I have an edge and I buy position myself and other will follow. So if you're that kind, then you can trade, but I'm not. So I pay attention to the volume. Breaking above the resistance. So if I have done so, so I open the loop in the beginning when the market, before the market open, and I close the loop after the market. So there is something called debriefing. So you need to do the debriefing, which I teach the process of debriefing. So I set the resistance level, support level. So when the stock breaks the resistance, I get the alert. I need to pay attention, especially if I have set uh, my target for profit target. So if the profit target is below the resistance for the calls and is breaking the resistance, then I need to pay attention to hold that position or not. So for Baba, let's say I set the resistance at, let's say 91 or 90, between 90, 50 and 91, Baba has resistance. So I put the 91 or 90, 50, something like that, alert. So if when the 90-50 hits, I get the alert and I'm in at 86.50. So 86.50, 90.50, $4 move. So I am up, let's say Baba 30-40% gain. So now I need to decide, do I take this 30-40% gain, or I hold? So if I'm holding at resistance for further gain, then I better do a good job in reading the resistance and what is happening at the resistance level. So if the resistance is at resistance, the volume should be up. At resistance, there should be some cannonball getting fired to break the China wall. So resistance is acting like a China wall. I need to have some kind of a system to read the resistance break properly. If I don't, then I will give back my profit. So 90, 50, 91 resistance at Baba, I should read the resistance correctly. If I don't, I will give back my profit and maybe I will see the sharp reversal to the downside. So I don't want to do that. Breaking below support. So if I'm in a long position and is breaking the support, I better pay attention that is breaking below the support. Or if the stock hits the support and I'm already in the position and it's reversing or it's holding, then I will add more to the position. Or if the stock is tanking and I read the support correctly, then I wait for the momentum to build and I will go long. The sharp reversal come when you can read the when you see the stock moving, let's say to the upside after a big move down, and the support is very strong. That's where the sharp reversal comes. That's where buying out of the money calls or the short-term calls make you a lot of money. Sharp reversal from resistance and sharp reversal from support, and then the crossing above moving averages, whether to the downside or upside. So the major moving averages like 50-day moving average or 200-day moving average or 20-day moving average, something like that. So I'm doing all this. Let's say I'm doing this. So price discovery, option evaluation, support and resistance evaluation, the targets evaluation, some catalyst is there, option volume is there, open interest is there, and the stock is constantly telling me that this is what is happening. So BYND breaking down U. So if you look at the U chart, Unity software, it gapped up. So it gapped up and it came to so when it gapped up, I pay attention to all the gap up stock. Some gap needs to be so gap, not all gaps are meaningful. So you need to pay attention to the gap stock, some meaningful gap. So some kind of, so gap needs to occur, something. So it's the software, Unity software gapped up today. And at 31.30, I saw that at 31.30. So then I said, oh, 31.30, it gapped up. What? So do I get in or am I late or what? So I have to do the homework quickly because it gapped up and I may missed it, the move, and my members missed the move too. So on one hand, so the job is very stressful, especially when this job of trading is very stressful, as you know, and it's very stressful when you are performing in front of live audience. So think about it. When I send the trade, I'm performing in front of a live audience. There are thousands of members depending on my trade. They're putting the money, they are trusting me. So my job is very tough job because I'm sending you the alert. So when I see the U trade and I'm thinking, I better make sure that the U is a proper trade. So I go on intraday. So it comes on a, let's say on a daily time frame. So on a daily time frame based on the price discovery. So something happened here. One of the criteria is getting filled. Now I'm monitoring Google on one hand. So think about it. Google gapped up. I have a big position. I see $25,000 profit. I need to take care of that. My members have various strikes on Google. HAL is going down. I need to send alert. I need to watch HAL on a 3-minute chart because I don't want to give back the profit. I see RBLX moving up, and I see some other stocks they are not moving. So I put them in a separate category called overview monitoring. So I put that, and on the ones. So I'm doing all this, and then I'm watching for a new candidate to the upside and downside. So U comes. So when U comes, I need to make the decision quickly. So, and the decision needs to be very bold and courageous. So there is a process of taking action. So process of stalking the trade on a lower level time frame and evaluating all the other things related to the trade, all the support, resistance, earning news, option chain, and which strike to buy, where will be the target, what will be my action. So you have to uh, visualize where the trade is going after you initiate it next 1 week, all the path thought process goes into, and then the understanding that, okay, this is the trade I take now, which strike, which month. So all that goes on, and I have to compose the email. I open my position and I compose the email and I send to you. So let's say it's not you, it's Meta. So when the Meta triggers, just replace the symbol. It can be dog or cat or anything. Just replace it. So let's say it's Meta. So Meta calls, and Meta is trading at July 230. So I'm buying at 10. We don't have any position in Meta. We closed. Meta, we had a long position and we closed it around 240, 41. And I don't have a position in Meta. So let's say July 230 call, buying to open at 10. So this is in the subject line, and the text message goes to you. You give us the phone number and the text message triggers. We send you the text. And in the body of the email, we say stock is Meta, month is July, strike is 230. There's a typo here, it's not 130. Meta used to be at 130. So now it's at 230. Imagine that. And it used to be 130, now it's 230. So type is call. So call or put action. What action is buying to open? What's the price? 10. And the option expires third Friday expiry. So always we buy because need to follow the standard option. So if you buying some weird strike, you need to make sure that this weird strike, let's say 230.33, that strike is non-standard, so it's not a standard. The strike happened due to some reasons, some dividend or something happened or a split. So maybe one contract, the standard is 100 shares, so that contract may be 150 shares. So you may get into trouble. So make sure and then the proper expiry is the third Friday expiry. So do that and send you the alert. So email delivers instantly from our server. We have a dedicated server for email. We have a dedicated server for text message. I receive my own copy. My team receives the copy, and we have a trading journal where we post the trade and get confirmed that you receive. So after we receive and I watch the order getting filled, I can see, some trades are happening. So I know my members, and if there's any question. So when I send the alert, then that's the limit price. Sometimes I really specify the limit price, especially if if the stock is moving and I see there's a spread there. So figure it out. What should be the limit price where the members should get filled. So get filled at the price which is the price I suggest, or lower. Sometimes you can shave the spread. So shave the spread, meaning if you're buying, if the price is at 10 and the bid is 960, 940, 950, then try to buy at 980, 990, something like that. So shave the spread. So don't just buy at the limit. And if you see it's not trading at that limit price, maybe if you plan to buy 4 contracts, so based on your risk management, a little notebook, a little Excel worksheet, or the phone calculator. If your system telling you can buy, you plan to buy 5 contracts, maybe you buy 2 contracts and the rest of the 3 at the lower price. Don't buy at the market price. The stock is usually trading at a narrow range, so it's not like the stock has exploded, uh, unless it's a U trade, which is exploding right now. Uh, Baba is fine, but the U is exploding right now. So if you miss it, you are way behind in a U trade. So do not buy at the market price. You can always figure it out. No panic. Buy at the limit price. Don't buy at the market price. Sometimes I sell at market when the stock is just tanking and I have a position and I just need to lock my gains. I know that it's reaching very fast towards my target. So I put the market price and the liquidity is there and the spread is narrow. So I know I'll be fine. Otherwise, I'm buying and selling at the limit price. So don't buy at the market price. Don't keep the order good till cancel. It's a day order. Usually it's a 5-minute order. If you get filled, you get filled. Otherwise, you cancel it and buy later. And then, so after I send the limit order, I send you the targets. So I send you the target, and the targets I specify are 3 targets. So green, I call it green, yellow, and red. So pay attention to these targets, shape the spread. And then there is a guide. As I explain the guidebook, people say, hey, you send the alert at $2 and now it's already at 250, 260. So maybe few hours gone by, or maybe you're looking at the trade next day and it's already there. So don't buy that. Don't need to chase. Don't need to chase. So I have this little guide on my trading system guidebook. If you don't have, you can ask us to send you. So this is a guide. So if the option is trading at 70 cents to $1, something like this range, you can pay 5 cents more, not 30, 40 cents, because that is the profit. If the price suggested was 70 cents and it's trading at $1, 30 cents up, that is like 50% gain. So you don't want to pay. So we are getting out maybe at $1.10 and you are getting it at $1.10. One thing, I don't go for 10-15% gain. So my trading is not for 10-15% gain. It's not. Minimum I require is 40%, 50% gain. So if the potential is not there, I don't take the trade. I'm not going for 10-15% gain, then quick, okay, 10% gain, I lock my profit. No, I don't do that. I will increase my win percentage in there, but overall the system is a loser. So it depends on your system, what kind of system you have. Every trade you send or trade the trade, if it's 100% win, then the option 10%, 15% gain is good. But if the ratio is less, 70% win rate, 60% win rate, let's say, if yours is like that, or even 80, then 10-15% gain is not advisable. There has to be some balance. So so know your system, what kind of a system you have on average, what kind of gain you get, and what is your win ratio. So what kind of average gain, what kind of average loss you have, what is the win rate, what is the average duration for the trade, the maximum duration, the minimum duration, and what happened, how much drawdown you have after you enter. If you are having a drawdown and the trade is then it moves up, so fix your entry. If you're exiting too early, sometimes the trade just goes up crazy after you exit. So figure it out what you could do to hold a little further. So do some analysis on the move happens after you exit. What kind of a move happens on average after you are exiting? So if majority of your stocks are going up after you're exiting, then expand your target. If majority of your position going down after you enter and then they come into profit, then fine tune your entry. So do both sides, because that will pay, that will increase your profitability. If you can fine tune your entry, you can closer to the, if you're going towards the long, and if you can fine tune your entry towards the support and read it correctly, then it means your risk is less and you can buy more contracts because the risk is less. So when the risk is less from the dollar point of view, your system is telling you you can buy more contracts, more shares, and the profit target is there. So entry is there, but the profit, if you're buying you at 31.30 and you expect it to go to 37, so if it's going to 37, so it doesn't. If you buy at 31.30 and exit at 37, and the stock moves faster, then you're making a certain profit. But if your entry is at 32.50, the target doesn't go from 37 to 38 just because you enter at 32.50. So you move your target to the upside 1 point. That's not the way, in my opinion, the trading is, because the chart is not, the stock doesn't know where you are entering. You may enter at 36, and if the resistance is 37, the resistance is at 37. It it the resistance doesn't move if you are moving your entry, and the resistance doesn't move if you enter at 29. So if you is trading at 31.30 and you happen to buy at 29, the resistance 37 doesn't move. So you have a lot of, you increase your profit. So when you increase your profit and the exit is at, let's say, 28, you say, okay, I'm entering at 29. If it goes to 28, I will be out. So there's only $1 loss in the stock. So you can buy more shares because your stop is very tight. So if your stop is very tight because you read very correctly, you can buy more shares or more contracts. Then your profit is higher. So don't move your target. So this is the guidance I have for paying extra for the option. So if you're buying a Tesla call and it's volatile, the volatile stock have a premium. So they move, so they have a premium. So if the same stock, same price, two stock having the same price, let's say 100, one stock option is trading at it looks like expensive, and one is look like, oh, this is only a $100 stock, this option is trading at $4. But the same stock, $100 stock, why is trading at $8? The difference is the stock is volatile, it moves. So when the stock moves and it's trading at $12 option like Tesla, then when the turn, so we had a Tesla, we entered in Tesla at around 165. I saw that 162, and we exited at 170, 172. So Tesla, $12 for Tesla, because it moves so much that if you have a email at $12 or 0.5 or whatever, you may pay 50 cents extra because um, it will go to 16 or 17. So these are some extra suggestions for you. Don't be anxious. Cancel your buy order. Don't keep it open after the day. Even after 5 minutes, you just cancel it and you can re-enter. If partial fill, then it's okay. You just buy more later below the price to average down. When you're averaging it down, then you don't just willy-nilly average down. Don't do the willy-nilly average down. I receive emails, hey, I bought at 10, it's trading at 9.50 now. Should I buy more? So don't do that because you're increasing your risk and bringing your average down to 20 cents. So don't do that. If you're averaging it down, you're averaging it down for some reason, and your average cost will go down, not just your average cost goes down by 10 cents. So don't do that. You're averaging it down for some reason. So uh, based on the stock, not just for the sake of averaging it down. If you do the averaging down just for the sake of averaging down, I bought so many contracts, my average cost is 5 cents now. So it looks like you started with the $1 and later you bought so many contracts, your average price is 5 cents. So all that contract may expire. You may not see it going to 10 cents. From 5 cents average cost, it needs to go to 10 cents. And so don't build like that, have some reason. So when you're entering in the trade, you need to know in advance where the stock target is. If you don't know the stock target, you don't know the risk and the reward, don't take the trade. You have to, especially the loss exit. So in option trading, imagine in option trading, the default loss you imagine is 100% loss for option trading, because anything can go wrong and time will run out. Because the option has a time component, it's a speculative or hedging purposes. So the time may run out and you will be right. So if you're trading option on stock or futures or commodity or anything, you need to assume that I may end up losing 100%, because anything negative can come, especially if you have a long position. Anything can come, the stock can tank and then rise up and you miss out. You will see it going way above your target and you miss out. So stock option is like that. So understand the target. So understanding the target is an art and science. So you have to know where the risk is and where the reward is. So I provide you 3 targets and I call it green, yellow, and red. So I provide 3 targets and I call it green, yellow, and red. A long time ago, like 10, 12 years ago, I came up with this name, like a traffic. Even the kid understand where what the green means and yellow means and red means. So that's the um, philosophy behind green, yellow, and red. So green is first target, yellow is second, red is third, and the fourth target, which is not mentioned beyond red. So red target is revised when the stock is gapping above and we already have a position. So for instance, Google. So Google is trading at 117.40 right now. The target was 112. So yesterday it went up 112.60 by market close. So today is gapped up. So the red target of Google is revised to the upside. So there has to be some reason for revising the target. Otherwise, your target is there. So traders lose money also when they cancel their sell order on acceleration to the upside and they don't read the chart correctly. That's where the traders lose money. They see the stock accelerating towards the target, and just before the stock reaches its target, they cancel their sell order because they think the stock is going up. So magically, your target could be magical, that when the target is hitting, there is an acceleration going on. That's the way the stock behaves. When the target is reaching, the stock is accelerating. That could be the climax move in terms of price and volume, and you cancel your sell order, and then you see the pullback, and then some emotions hits because you saw so much gain, and now you're not seeing that gain, the dollar amount. So you saw $1,000 profit, now you see 800, now you see 700, 600. So you say, no, like I will not sell at 600 profit. I want my $1,000 profit. So that $1,000 may come and may never come. So when you have a target, always have a sell order in advance, good till cancel there. If you're not there in front of computer or you're not monitoring, you're in the meeting, at least your position is sold. So have the sell order ready, implement it, and you can always cancel. But when you're canceling it, you need to make sure that you're canceling it for the right reason, and you're not canceling it because of the greed or excitement. So the excitement brings the greed, and you cancel your order, and that's where the stock pulls back and you give back. So that hurts. So the green target is, the way the green target is defined is a clear cut sailing from your entry price to some level, meaningful level. So if you don't have a meaningful level, then don't take the trade. So the green target have a very high probability of hitting. So I give you example of so I give you example from the travel point of view. So I live in San Diego. So from San Diego, if I'm traveling, let's say it's a long 1 week vacation or something, 2 week, I'm going to Seattle. So I'm leaving San Diego at 6 a.m. in the morning, and I put the GPS, and GPS says 72 hours to Seattle. So it doesn't mean I will reach Seattle in 72 hours, because I know there are a lot of hurdles in between. I will get tired, I will take exit, I will sleep, eat this, that, and I will reach Seattle maybe in 1 week. But I know pretty sure that Los Angeles, I will arrive in 55 minutes. GPS, when I put, so I change the GPS. I know Seattle 72 hours, but I say, no, 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 no. The Seattle is too far right now. Just make it to Los Angeles. So when I put the Los Angeles, it says 55 minutes, and it's Saturday morning. So Saturday morning, Los Angeles from San Diego, 55 minutes. I bet I will arrive in 55 minutes unless I take an exit. So that's the way it is supposed to be. It's Saturday morning, going from San Diego to LA. If the GPS is saying 55 minutes, I will arrive in 55 minutes, maybe 56 minutes. So there's a 95% probability of his stock hitting that target. So when the stock hitting that target, I should have some meaningful profit. For any reason, I may have to exit fully at this target. So maybe, so when I reach Los Angeles and I decide not to go to Seattle, I have a reason to stay in Los Angeles, and I may never go to Seattle. I just make a U-turn and come back home. So when I'm hitting the green target, I have decent profit, and in the option, the at least 30-35% profit when the green target hit. So when the green target is hitting, we send you the alert to sell 1/3. Sometime we do at the green target, we ask you to exit 1/3, sell something, because we want you to maximize. So majority of our target alerts are sent when the yellow target is hitting, the middle one. So sell 1/3. If we send you the sell 1/3, if the stock just hit the green target and there is something is telling us that the stock may pull back after hitting the green target, we send you the alert to sell 1/3. Or we may even tell you to sell all if the green target is hitting and number of days have gone uh, past. So if a certain number of days pass, then we say, okay, we don't hold this any longer. So green target is enough. We have 30% profit, and the stock took 7 days to hit this target. Otherwise, just assume that it's a clear sailing towards the green. There is no resistance there. The yellow target is the second target. So yellow target is defined based on some kind of a resistance level for the calls, and some support for the short position. So for instance, I'll give you example. The yellow target for HAL 28, 20 or something. So some kind of a support is there. So some kind of a pullback can occur. So sell half or sell majority if when the yellow target is hit, because some kind of a temporary resistance is there or support is there, and the stock may do its thing to up and down, and then it will fall further. So in case of puts, so the distance between the yellow and the red, the next target should be meaningful for me to hold. If the distance is very close between the yellow and red target, then there's no meaning for me to hold for the red target, because there's not much distance, and the time it will take. So I don't do, I sell all. If there's not much distance between yellow and red, then I sell all. But I do send you the trade alert saying sell half or sell majority. And if the stock hesitates after the yellow target, then we send you the alert to sell the rest. So we do that. Now, the ultimate target is the red target, which is where the most of the profit is. So 80%, 90, 100% gains. If the stock is hitting the target faster, that's where the most of the gain comes in terms of option trading. So, but because the distance is far, so from San Diego to Seattle, the distance is far. So the red target is meant to be where very significant gains uh, can be achieved, and especially if it hits fast. So the moment we enter the trade, and the next 2-3 days, it boom, 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 it goes and hits the red target. So when it hits, the gain is in option explodes. And if it takes time, then the red target gain could be the same as yellow target. So whatever the case is, we send you the alert, sell rest. If we have already sent you the alert to sell majority or sell half or whatever, if sell rest, otherwise we send you the alert to sell, just a second, to sell all. So there could be a reason to sell all at red target. So for instance, let's say Google. So Google trading. So Google is trading at 117.25. So, and it went above the red. So what is the odd? What is the chances? What are the chances that if I hold Google after gapping up towards 117, 114.50, and then 117, what are the chances of me making more money by holding my June calls in Google and expecting Google to move further up after this big move? What are the chances? Will I be better off if I just keep holding my June call, or should I sell and wait for Google to pull back some meaningful support, and then I initiate with the July call? So I have to make the decision. So sell all. It crossed the red and sell all. So action to take a red target. So so the red target, from the initial point of view, the red target is for the call. For the long side, the red target is defined just below the resistance, some major resistance, some major turning point, something is there based on intraday, based on the chart. So if I want to hold at red, then the stock should gap above the red target. So um, um, recent examples, CRSP, Airbnb, AFRM, Google, and others. So it stays above the red. So stock must cross the resistance. So resistance, just think about it. Resistance is a supply zone. So resistance is where the suppliers are, where the sellers are. The demand is where the support is, where the demand is, where the buyers are. So, and it's not one price, it's a range. So resistance is a range and support is a range. So just think of as a river, as a river. Sometimes the river is wide and sometimes the river is narrow. So and imagine that somebody is chasing you. So when you see the movie that the bad guys are chasing you and the dog is there and he's coming closer, the movies, and then you jump on the river and then you try to swim across. But what if you get the magic carpet and you just go on the other side of the river? So the stock behave like that. There's a supply zone, a channel, and suddenly the stock gaps above that channel. So when the stock gaps above the channel, goes above on the other side of the resistance, other side of the river, you cleared all the sellers. Now all the buyers are there. So it better hold. You better hold. You better stay above on the other side of the river. You don't want to come back in the water, because the water may take you back towards the bad guy, and that's where the sellers are. So you have to decide that this resistance range is clear cut, I understand, and the stock gaps above the resistance, so I need to hold. So I need to hold, and if it breaks, it come back to the range, seller's range, resistance range, then you need to sell immediately. There's no need to sell. So for instance, Google, sell all, especially if it's June calls. If it's in your retirement account, then keep holding Google. So when then the target red is broken or in the pre-market, so we evaluate the trades during the pre-market. We send you the revised red target. Hey, this is the red target, and we are revising it because why? Because the markets are dynamic, and you need to be flexible. So uh, on one hand, you don't change your target when you are initiating the trade. You know your target, but because the things are happening in that symbol, in that trade, that you are acting upon the things which are happening and you're taking action. So you are going to revise your target, but must be uh, must be accurate in revising it. Must have some reason to revise. And the red target is revised because of the more gains. So we do revise the targets for the calls to the upside and for the puts to the downside if we see the potential. So we send you the alert. And sometimes the target, when you initiated the trade and the stock is looks good from the target point of view, and then it will start to the action just dies down. So for instance, Baba, I give you Baba. So I initiated the long position at 86.50, and let's say my target is 90.50 for the green. So I give you example. My green target, let's say 1950. I enter at 86.50, and the yellow target is above at 93 or something. And then what happened at 90.50? It just dies down, and the Baba is not moving. So I may need to revise the target to the downside. So you need to revise the target to the downside, and you need to revise the target to the upside. But you need to have a proper way of, and must have a valid reason. Otherwise, don't revise it. So you can revise to the downside, but don't revise to the upside if you cannot figure it out, because you may see your profit evaporate. So these are some of the examples of our trade alerts that we send you. So I follow a complex matrix I've developed. So there are many reasons for exit. Successful traders, they exit for multiple reasons, and they are exiting for multiple reasons, and they are entering only for one reason, because they know that the stock, they have decided that the stock is, if they're going long, it's going up, or if they're going short, it's going short. But for exit, there are multiple criteria. It needs to be complex, and it needs to have a you need to have a multiple criteria and a complex criteria to maximize the gain. Scaling out and adding more and scaling out are different reasons. The stock exits for multiple reasons. So these are some of the sell alerts we send you. Pre-market, so traders don't pay attention to the pre-market action. It's very important. You need to pay attention to the pre-market, and also if there's a news aftermarket, earning, etc., or some major product announcement, you need to pay attention and see what was the high and low made, and that high and low the stock should be trading. If you have a long position and it's making some kind of a high in a pre-market, that stock needs to make a new high in the regular session. If it's not making the new high, then something is wrong. And so if Google in the pre-market trading at 114 and it opens and it doesn't go above 114 and it continue to move above 114, then pre-market high was the high. So pay attention to the pre-market or aftermarket. Some event needs to occur. Some event is occurring. So pay attention to your position during pre-market. That's why you need to wake up a little early. If the high of the pre-market is not conquered during the regular session, or the low of the pre-market is not conquered during the regular session, that could be the ultimate target hit. And the problem with the option trading is when the stock gaps up, let's say the stock gaps up and you're very happy, but the option is not trading for the first 15 minutes. So the market maker of the option has not opened the trading for you. He is taking care of his books, and he will adjust his ask and bid depending on what he's seeing, because he has to go home with the profit. So the stock may be pulling back. For example, look at GT. So GT gapped up big time towards 15, 20, something like that. And if you have options, if you have a stock, you can sell at the right at the open. You see the pullback. But if you have option, maybe you need to wait 10, 15 minutes for the option to open up, and then you breathe, and then you say, okay, this is the price I need to sell. The spread may get wider sometimes. So, stock may have multiple reasons to make a high or low during the pre-market hours, and even though they are making a new high and low during the regular session, during the first 10 minutes, you don't get the chance to sell your option because you're at the mercy of the market maker. So, but when it opens, then you can take action. So the stock must gap above the red for calls and below red for puts, and must continue its journey. So some kind of a way of you to analyze that the stock is making its move. So I monitor it, my team monitor it, so I make it easy for you to take action. You're not doing all this work, so I'm doing it, and my team is doing it. So pre-market alert and strategy is sent to members. All this I'm telling you is I am doing it. So now I add more to the position. So when the stock is building, is telling me that the decision I made when I initiated the trade was right decision. So I add up. So adding to the existing position is a good strategy. If let's say you think Google will go towards 125 and you exited at 117, maybe um, you can buy a new strike. So if you have 110 strike, 117 is way deep in the money, and so it's moving dollar for dollar. You may buy, and you have a June strike. So if you have June 105 calls in Google or June 110 calls, and Google is trading at 107, so it's way deep in the money. So you sell it because the options are trading at 11 and 12. You may sell Google calls and buy the July calls. So if you think there's no pullback and it's the right time, that's the way you trade. I don't trade like that unless I can see the continuation. So I close one strike 1 month and then open another one. But for Google, I will not do that. So for July, you can buy July calls now, and with the strike 120 or 115 or 125. So whatever is your strategy, so you do that, or simply create a spread by if you have a margin account, you can sell, let's say 120 strike against your 105 calls or 110. So you locked your gain. Now you created a spread. So you can do many strategies when the stock is doing its thing and breaking out. We also send you news update or constant update to either hold, show you the charts. I will prepare some charts and show you maybe this weekend. Volume update if the volume is building up. And we send you the alert to get ready to lock the gains. So we do all that. Sometimes we do send you alert to buy more, to average down, and buy more at the higher price. If you may not have the trade, so or you may still have the trade, but we see more potential. So we know that we send you the alert at 10 and it's trading at 12, and it's still good to buy more because of the way the stock is moving. So we do send you the alert to buy more. So here's the example of Meta, July 230. So this is a typo here, July 230 calls, buy at 6. So if you bought one contract of Meta at 10, then at 6, you will be buying two. So that's the formula, that you are investing equal dollar amount in the average. If you cannot do that, so if you buy at 10, one, and then you're buying one more at 6, so total cost is 16, so your average is 8. Whereas if you're buying 10 and you buy two contracts at 6, so 12 and 10 is 22. 22 divided by 3 is like $7 and something for your average price. So equal dollar is suggested to buy more. If we do send you the percentage, the options price to sell, option price to sell. So if let's say yellow target is the yellow target. If we enter at 100 and the yellow target is 112, then we estimate what would be the option, and we send you the estimated option price. We send you the estimated option price to sell at this. But if you cannot, if you don't want to set in that way, then you can set up the conditional order. The conditional order is based on the stock target. So when the Google hits 117, please sell my contract at the market price. So the contract needs to be very liquid. The market should be, option market should be very liquid. There's a tight spread between the ask and the bid, and you sell, your orders will will trigger at the market price when the stock hits, let's say 117. So you can set your order in advance. When the Google hits 117, sell my call contracts, one or two or three at market price. So that is the philosophy behind conditional order. And here are some examples of our trades we did recently or some past. Anyway, so this is the end of my presentation. I've been talking for 1 hour 45 minutes. Uh, so um, so this is what it is. I hope you understand how you should be following the trades. TECK, let me see. So we don't double down. Again, somebody is asking, can I double down? You don't double down just like that. So we don't double down. We double down or we buy more when we see the move, when we see some reason to buy. We don't double down just for to bring the cost down, because you may be catching the falling knife. So you don't do that. And once you have you should have a conviction in your trading. If you have a conviction in trading and in your trade, that trade, you need to hold. You need to give some time to work, because option can move $1 on this side and $1 on the other side, and the stock is just behaving in its range. Its stock is doing its thing. So let the stock do its thing, and hold and average down when the time comes to average down. Don't average down just because to bring the cost down. That's not the right trading. You should also be looking at averaging it up. So when the winner trade is there, you need to average up. Don't just sit there and say, okay, now I wait for my profit. So have some way of and buying more. So that's where your own if you cannot do that, if you're just following a strict, then you do. Otherwise, if you are trading on your own and acting on the trade alert, you can create fortune and from the trade alerts. All right, so I need to go, and I will talk to you. So don't close TECK, please. Intel has not hit the stop, so don't close Intel. Baba, I know Baba is sitting at 87.55, so there's not much profit. We entered at 86.50, so Baba 86.50 is you shouldn't be exiting unless you just make 10% gains. I don't know how many percentage gain right now, so you hold. You has resistance at 33, so it's just hitting the resistance, but I call it cannonball. So when the stock is hitting the resistance, which is 33 for you, it needs to hit the resistance with some fireworks, some big momentum, some volume, some brand new catalyst. So expect the U to break the 33 resistance. So just don't tell. BYND is BYND 1080 is is we entered when BYND was 1105 and it's at 1080. So I expect BYND to go further down towards 9. Just a second. So BYND will I expect to break down towards 9. All right. So all right, then I will see you. I will hold this webinar again on try to hold this again on weekend, and I'll show you some charts also. All right. So thank you. I go now. It's 2 hours.